Good afternoon. Your market news now. Stocks in Japan led losses in major Asian markets after the recent rally in U.S. stocks broke momentum, with the Nasdaq snapping a three-day winning streak. Japan's Nikkei fell 1.2% and Hong Kong's Hang Seng Index fell 0.3%. Mainland Chinese stocks struggled for direction. Meanwhile, China's exports grew slightly more than expected in December, while imports rose less than expected. Exports rose by 20.9% year-on-year, and imports grew by 19.5% in dollar terms, missing expectations of a 26.3% increase. This pushes the annual trade surplus to a new high, providing support to an economy being dragged down by a property market slump and sporadic COVID outbreaks. In the U.S., companies have started posting quarterly updates, but reporting season will get into full swing today when JP Morgan, Citigroup and Wells Fargo release results before the market opens. To talk to us about how all of that is playing out and I suppose also look back at the week that was, we are joined by Lukman Otunuga from FXTM. Lukman, thank you so much for your time. I mean, it's Friday. The market hasn't stopped trading. We're sort of in midday trade, so to speak. But when you had to look back at the past week, what were the key themes for you that, dictated where markets were going?
Certainly, I think this has been another eventful week for financial markets. One has been influenced by inflation fears, volatility in the stock markets, action in the FX space, the dollar depreciating, and Fed hawks. We've had some key economic data from the United States, from China and other parts of the world that's also influenced global sentiment. But I think overall global stock markets have been on a roller coaster ride this year thanks to Fed rate hike expectations, while the dollar continues to weaken and gold prices are benefiting from a weaker dollar.
I mentioned in my intro, what's happening with the Asian markets following what we saw yesterday. I mean, when you look at the sell-off yesterday carrying through into Asia, is it a case of, I suppose, buy the dip opportunity, or is the market assessing the medium-term outlook for, some of the sectors that could be affected by tightening?
Certainly, I think when we look at yesterday, we saw the chorus of hawkish Fed officials, which simply reinforced market expectations of the Fed tightening sooner than expected. In fact, money markets are expecting the probability of a rate hike in March around 91%. So today, we've seen Asian shares closed red, European shares are flashing red, and US futures are, looking like a sea of red. I think the idea that, losses are being filled by tech stocks, which are highly influenced by interest rates, is going to be a major theme. And moving forward, more losses can be seen across stock markets as investors shift their attention away from expensive growth stocks to cheap value stocks. So I don't think this is more of a buy the dip opportunity, but the fundamentals dragging equity markets lower.
I've been asking myself this question, and I'm wondering whether you asking yourself the same question as well, in terms of the Fed. I mean, how hard will it be for them to be able to deliver more than what the market is expecting this year?
Yeah, the Fed has set the bar quite high. Expectations all over the place. Some are expecting 3 to 4 rate hikes this year, which is quite aggressive. For the Fed to do more, this will be heavily influenced by inflation expectations, economic growth in the United States, and of course, the development revolving around Omicron. Moving forward, though, I think signs of faltering economic growth in the United States or soaring COVID cases in the United States may complicate the Federal Reserve's efforts to move ahead with the 3 to 4 rate hikes markets expecting this year. I think it's also worth considering that, especially by the taster over what tightening can do. If the Fed acts too quickly, this could create havoc across financial markets. We could see a sharp decline in stock markets. So much is on the table right now, but I think the major focus is the developments in the United States, inflation expectations, and whether Omicron cases continue to rise or fall.
Which is, a nice lead up into my next question, because I was going to ask you whether the risk of policy error is still in the market. I mean, is the market still worried about, central bank policy error, or how's the market looking at it at this point?
I think moving into 2022, this is, I think, one of the key risks global investors are looking at. And yes, at this point in time, we've seen, if I would be colourful here, inflation in the United States is like an unwanted guest that is overstaying, that doesn't want to go away, persistent inflationary pressures. This is why the Fed has adopted this aggressive monetary stance to tighten to raise interest rates. But imagine if we have a situation where inflation may actually be peaking and over time inflation continues to cool down. We could have a case where the Fed may be, over tightening, which could negatively impact US economic growth. So there's much on the table right here, and I think it's one of the key risks to look out for. We probably may have more direction in Q2 or Q3 of 2022.
So let's bring in the other aspects of this, and we hardly talk about it enough, and I know you do focus on it quite a bit, gold and the dollar. What has been the movement there following everything that's happening globally?
It's been a wild week, Nastasia. Like I wrote an article earlier in the week, and I said, "Is gold in trouble?" But as we can see, gold has actually had a great week despite inflation in the United States peaking at levels, hitting levels seen in their 40 years. I think moving forward, though, gold is going to be heavily influenced by the movement in the bond markets, dollar valuation, and of course expectations revolving around how aggressive the Fed is going to raise interest rates. The same is going to be with the dollar. I think what we saw this week, especially the dollar tumbling and gold pushing higher, is that markets may have been expecting inflation in the United States to be slightly higher than the 7% level. So it was, priced in. Moving forward, though, the fundamentals still remain in place as expectations continue to rise over the Fed tightening, and we see the dollar strengthening and treasury yields rising. The dollar is going to strengthen, and ultimately this is going to drag gold prices lower. So fundamentally, I'm bullish dollar, bearish gold for 2022.
All right, Lukman, thank you so much for your time. That is Lukman Tunuga, from FXTM. And other events that market participants are looking out for is the New York Fed President John Williams' speech. We've had a slew of the Fed presidents from various states reiterating the call for Fed hikes. But we'll also be looking out for the U.S. December retail sales, industrial production, and the January consumer sentiment. So we'll wrap up all of that for you and see how that is unfolding as markets continue to trade. We're going to take a break now. After the break, we'll have your money.